All right, now we're going to move into a discussion of the various journal entries that are involved with equity transactions. And a lot of this will be review because we have talked about this in previous chapters. So remember, common stock is held by investors who are the owners of the corporation, and those stockholders have the right to vote. They share in the profits of the business if the business gives out dividends, and they elect the board of directors who hire and monitor the executives to make sure that the executives or managers are working in the best interest of the owners. Also remember that when we issue stock, there's this concept of par value, which is a nominal value per share, meaning it has no true meaning. It's established by the corporate charter. It used to be the amount of capital required by the state that must be invested in the business. But because now in most states the par value is so small, like a fraction of a penny per share, it really has no real meaning. What it does is it affects the way we record the transaction on our accounting records. So par value has nothing to do with market value. It's an arbitrary amount that's just set by the state you incorporate in. It's a very small amount. It's the amount required by the state to remain invested in the business. But because it's such a tiny amount of money, it really doesn't have a whole lot of meaning. What it does is it affects the way that we record the transaction. So remember, under equity, we have contributed capital and retained earnings, and then our contributed capital can be further broken up into our common stock and additional paid-in capital. The common stock is where we put the number of shares times the par, and the additional paid-in capital is going to be the difference between the amount of money we receive and the amount that goes into that common stock account. That's the only impact that par value would have. So let's look at an example. An initial public offering, or IPO, involves the company's very first sale of its stock to the public. Additional sales of stock are called seasoned offerings. It's important to note that when or after a company sells its stock to the general marketplace, when shareholders then resell their stock to other shareholders, the company isn't involved at all. So the only time the company has to do a journal entry is when they sell the stock directly to the owners. So if IBM sold 100,000 shares of its 20-cent par value common stock for $150 a share, how is that going to play out? Well, as we learned at the very beginning of the semester, we should always be thinking in terms of up-down under our accounting equation. So first, under our equity, common stock is going to go up for the number of shares times par. So that's going to be 100,000 times 20 cents. And that's where the 20,000 comes from. Our cash is going to go up by the number of shares times the selling price. Let me put the equation here for you for common stock. Number of shares times par. So the number of shares is going to be 100,000, and we sold it for 150 a share. So that's where the 15 million comes from, and the difference between the 15 million and the 20,000 that went into common stock is 14,980,000. So you can see why this par value really doesn't have a whole lot of meaning, because it's such a small amount compared to the total selling price of the stock. The selling price of the stock is determined by market conditions. The par value, remember, is just an amount set by the state you incorporate in. So when all said and done, assets and equity both go up by the full 15 million. The par value just impacts which accounts get that 15 million. Common stock is the number of shares times par, and then additional paid-in capital is the difference to make the accounting equation balance. To convert that to debits and credits, to make assets go up, we debit them. So we're going to debit cash by, again, the number of shares times the selling price. We're going to credit common stock, always for the number of shares times the par. And then additional paid-in capital would be credited for the difference. And that makes debits equal credits, as well as A equals L plus E. We learned this way back in, I think it was chapter 3, so this hasn't changed. The process hasn't changed for recording equity. It's the same thing we learned back in chapter 3. Again, as I already mentioned, sale of stock on secondary markets, that is when one investor sells to another investor, doesn't affect the corporation. They're not a part of the transaction, so there's no journal entry that needs to be recorded by the corporation. Managers may be offered stock options, which is a common form of compensation, which permits them to buy the stock at a fixed price. So basically, if the price is currently $10, management might be offered stock options to buy the stock at $12. Nobody's going to want to buy at $12 when they can buy it on the marketplace at $10, but the idea is that incentivizes managers to do things that'll increase the stock price. So if the stock price goes up to, say, 20, then management exercises those options and buys the stock for 12, they've got an immediate gain. So that's one way a corporation can incentivize managers to do what's in the best interest of the owners, which is increase the stock price. In order to provide those types of stock compensation, whether it be stock options or just they give shares of stock out, they need to have those shares. So that means that the corporation needs to repurchase shares of stock. They can't just issue additional shares of stock because that won't be in the best interest of owners. If they issue new shares of stock to the employees, that dilutes the ownership, and it would be unfair to the current owners. And in fact, it wouldn't be allowed, because one of the benefits of owning stock is that you have the right of preemption, which means that anytime new stock is issued, the current shareholders have first dibs, meaning they can buy it before any new shareholders do if they want to. So in order for a company to pay its employees with stock, they need to repurchase the stock. So by repurchasing the stock, that allows them to fulfill their bonus obligations and avoid diluting the current shareholders' ownership. So stocks that are repurchased are referred to as treasury stock, and that treasury stock can then be issued, either resold to investors, or it can be provided to management as stock compensation. Treasury shares, that is when they're owned by the company, have no voting, dividend, or other stockholder rights. Think about it. How can a share that's owned by the business pay itself a dividend? That would be like me taking money out of one of my pockets and putting it into another. Nothing really would happen. And treasury shares also have no voting rights, because the people that are supposed to vote are the owners. And when treasury shares are owned, the treasury shares are owned by the company, so there's nobody that could vote on behalf of those shares because the company isn't a person. So how do we go about recording the repurchase and the subsequent reissuance of treasury shares? Well, it's quite easy. When we repurchase treasury shares, we record it at our cost. So if IBM reacquired 100,000 shares when it's selling for $140 a share, what happens is we record treasury stock at the number of shares times our cost, and then we credit cash for the number of shares times our cost. Basically, this is the opposite impact of issuing shares. So if I do my A equals L plus E, what happens when I issue shares is assets and equity both go up. So when I buy back my shares, it only makes sense when I purchase treasury stock that assets and equity both go down, because selling stock and buying it back are opposites. So that should make sense that the transaction has an opposite effect. So when I issue stock, my assets and equity go up. When I buy it back, my assets and equity go down. Treasury stock, the account we use to track the purchase or repurchase of our shares, is a contra equity account. That means it's a negative equity. So what happens is the treasury stock account is going up, but that in turn makes our equity go down. And you may also note that equity does in fact go down with debits, so that's consistent with the journal entry. By debiting treasury stock, we make the treasury stock contra account go up, but that in turn has a negative impact on overall equity. And then crediting cash, anytime you credit an asset, it makes the asset go down. So that should make sense because, again, buying our own stock back is the opposite of selling it. When I reissue the shares, this is what gets students in trouble, so pay very, very close attention. When I reissue those shares, I have to remember a very important rule. I need to take the shares off the books for what I put it on at. So when we purchase these shares, we purchase them at $140. So when we resell them, we need to take them off the books for that same $140 cost. So the journal entry is going to involve increasing cash by the number of shares times the selling price. And here's the important part. We're going to decrease our treasury stock by the number of shares times, and it's so important, I'm going to change the color, the cost of those shares. And then additional paid in capital is the account we use to record any difference. So again, whenever we reissue treasury stock, you want to remember to take the treasury stock off the books for what you put it on at, which is that cost. A lot of times students will make the mistake of debiting cash for the $1.5 million and crediting treasury stock for the $1.5 million. But you can't do that because we put the treasury stock on the books for $140, we got to take it off at $140. Any difference would just go into the additional paid in capital account. In this case, we needed an extra $100,000 credit in order to make the journal entry balance, so that credit went to additional paid in capital. If instead we resold the stock for $130 a share, we would still debit cash for the number of shares times the selling price. We would still credit treasury stock for the number of shares times the cost. And then again, the difference would go to additional paid in capital. However, in this case, the difference is a debit because in order to make our journal entry balance, we ended up needing a debit to our additional paid in capital. Let's go back to the original reissuance of shares just to show you the impact on the accounting equation. When we reissue these shares, ultimately what happens is our assets go up the $1.5 million and our equity ends up going up by $1.5 million. So it's just like when we issue stock for the first time. Assets and equity both go up. The accounts that are involved are different, but the overall impact of the accounting equation is the same. So again, when we issue stock, assets and equity go up. When we buy it back, assets and equity go down. When we reissue it, assets and equity go back up. And even in this case where we reissued it for less than we purchased it, assets and equity still go up. So assets go up 1.3 and equity goes up, in this case, 1.3. Within equity, we have treasury stock and we have additional paid in capital. So the treasury stock is going down by 1.4. But remember, that makes equity go up by that amount. And then additional paid in capital is going down 0.1, which is 100,000 in decimal form. So the net effect is that our equity goes up 1.4 and down 0.1. So overall equity goes up 1.3. So both assets and equity go up. Treasury stock's a little tricky. Remember, it's a contra equity account. So as the contra account go up, equity go down. And in this case, when we're reissuing the shares, the contra account's going down, which makes equity go back up. The key here to remember, once again, is that when we reissue shares of treasury stock, you got to take it off the books for what you put it on at.